Well, as we mentioned, the consumer is still spending. November retail sales posted surprise growth, signaling US shoppers remain in a better position than feared. But just how long into 2024 could it take consumers to start feeling that spending fatigue? Let's bring in David Tinsley, Bank of America Institute senior economist, to weigh in here. So we touched on about this dichotomy about why consumers are still spending, not necessarily on the necessities as was first the case. What is happening here?
Well, I think as your report was just saying, there was strength in the retail sales numbers in November. And interestingly, when we look at our data at Bank of America Institute that covers our 69 million customers, we see strength not only on the retail side, but also in the services side that the retail sales data obviously don't cover. So in the run up to to Cyber Monday and Black Friday, we saw strength over that period in airlines, and also in event tickets, for example. So it's not just a story about good spending, retail spending. I think the big thing that's happening is the labour market. So, your report was touching on the fact that people hate inflation. Of course they hate inflation, but if they're getting a pay rise, then they can afford at the end of the day to cover those price increases. So it's a labour market story that's powered the consumer by and large this year, I think.
And as you've noticed, some of the labour market trends now broadening throughout different, whether you're low income or higher income, how is that impacting what we're seeing now?
Yeah, that's an interesting point. So basically, we can look at the pay rises people get in our data when they change jobs. And we are seeing a slowdown there. We're seeing that during the Great Resignation, people were getting 20% rises when they changed jobs. And that's now settled down at about 10%. But that's roughly where it was before the pandemic. So there is a slowdown. It seems more concentrated at the younger generations, the young, than the older generations. But really, at the moment, it's not really a sufficiently large slowdown to put the brakes on consumer spending, which, as you were saying, really has been strong all year, and also supported, I think, by the fact that these deposit buffers that we discuss are still up sort of 30% upwards relative to pre-pandemic. So people still feel relatively comfortable, I think.
And David, I want to dig into how different demographics are spending, because we talked about younger consumers here. And in your data here, looking that they're more cautious in their holiday spending than baby boomers. You also have Gen X and millennials, really honing in on some of these promotional periods. How does that factor into what we can expect into 2024, especially as some of these bills come due?
Yeah, I mean, the jury's out really on spending over the holiday season for the generation. So what we noticed was that the older generations were spending firmly throughout November on holiday items. The younger generations were holding back until the holiday weekend, and then they ramped spending. And in a survey we ran, we found actually that the millennials weren't particularly planning on cutting back their holiday spending relative to last year. So the jury's out. They may come good, if you like, and keep spending throughout December. I mean, looking to next year, I think what I say is the fundamentals remain broadly in good shape right now. The labour market, as we discussed, has slowed, but is certainly not slowing precipitously. The deposits, the savings and checking account cash that people have on hand to support their spending is coming into the new year in, relatively high still compared to where it was before the pandemic. So across the piece, there's support. There are headwinds, I think, that particularly hit the younger gens. So I'm thinking here of student loan repayment, utility bills, childcare costs up 30% or so relative to pre-pandemic. So that particular cohort getting hit quite hard there. Renters, of course, have suffered pain in the past. So I think the headwinds are blowing harder on the young, but the overall picture is pretty solid.
And so, David, as we look ahead to 2024, and obviously still waiting for all of the medicine from the Fed's actions to trickle through the economy, what do you think are some of the key things you'll be watching for in consumer behavior?
Well, I guess, really how these headwinds play out and how the consumers cope with them. So at the moment, when we look at our data, we can look at people who are making student loan payments, have a look at their spending, and we're not seeing any real significant signs of a pullback. So that's good news. But of course, there's a ways to go in that story. Some people are making use of the administration's on-ramp and haven't started paying yet. And then all these other cost factors I was mentioning, childcare costs, utilities, etc., they will come to pass. I mean, I think at the end of the day, it's going to be down to the labour market. If the labour market slows in a sharper way than most economists are expecting, then I think there'll be more pain. But at the moment, from our data, things are fairly benign, I'd say.
Sure, and still, some healthy savings there, perhaps a little bit of doom spending as well, heading into the winter season. Appreciate you joining us this morning. David Tinsley, Bank of America Institute Senior Economist. Thank you.